today we'll talk about general long-term liabilities. We talked about general long-term assets. Now we'll talk about general long-term liability. So, as a start, what was so interesting about general long-term assets? Where did they show up and where didn't they show up?
Government-wide statement.
They showed up in government-wide statements but didn't show up in the governmental fund financial statement. Well, the same thing is true with general long-term liability. So the question is, what are these general long-term liabilities? We talked about the capital projects fund. Remember that?
Yeah.
Well, we have to pay for that project somehow, right? How do you think governments pay for capital projects? By borrowing money.
Yeah.
And to do that, they issue general obligation bonds or GO bonds. And once they are issued, they have to be repaid, right?
Yeah.
So that repayment process runs through what we're going to talk about, which is the debt service. So just like capital projects fund is used to account for construction of an asset, the debt service fund is used to account for payment of the liability associated with it. So do you ever carry a long-term liability on the debt service fund? No. So that's what we'll talk a little bit about is how they're displayed and what those liabilities are. One of your favorite things, journal entries, how they're recorded, when debt is issued and when it's repaid, what the note disclosures are for long-term debt. Okay. And we'll talk about a couple of these technical terms, which is this concept of debt limit, debt margin, and overlap of debt. Big words for very straightforward concepts. Okay, and we'll talk about that. And then we'll look at the type of debt service fund. But more importantly, we'll talk about the principal type of bonds which are issued by government. Serial bonds and term bonds, and how to make those general entries for that. So let's start off by defining what general long-term liability is. First, any liability of the proprietary fund or fiduciary fund is not a liability. It's not a general long-term liability. General long-term liability is associated with the governmental part. It's what? It's accounted for in that reason. So if you see debt issued by a sewer authority or water authority, well, that's not general long-term liability. Those are revenue bonds and others which are backed by the revenues of that facility, as opposed to debt which is backed by whom? General long-term debt is backed by, who backs those bonds? Who's responsible for the payment of those? The taxpayers, right?
Yeah.
So taxpayers are very much interested in when and how much is debt issued. For instance, you owned a home in a community which decided to go out and borrow money. Why do people get somewhat excited about that? Because in order to repay the debt, where does that come out of? From your property tax. So the fear is always what? That debt can lead to higher property tax. But for government, there isn't any other way out. In order to build projects, large construction projects and other infrastructure improvements, the only way to pay for it is by doing what? Going out and issuing bonds. Okay? So we talked about How do you account for those in the capital projects fund? Now we'll talk about what happens when you issue bonds and when you have to retire them. So the first item of interest here is that they are not debts which are contained in the proprietary or fiduciary fund. So what are some of the examples? The examples of these long-term liabilities are tax-supported bonds, and it's some of you might get a little confused with that. What is a unique characteristic of government debt? It's tax exempt, right? And that sounds like tax-supported. Well, it doesn't mean tax-exempt. It just means it's supported through property taxes. Okay? Long-term warrants, long-term notes. Next interest is capital lease obligations, and I'll talk a little bit about that. Unfunded compensated absences, we won't deal with that right now. Unfunded pension obligations, we won't deal with this right now. But we will deal with pollution remediation obligations in a moment. Okay? So our class is focused on these general obligation bonds. Financing taken to what? To provide a funding for what? For to build our assets, to acquire them. Okay? But there are a couple of other things, capital lease obligation and pollution remediation. So before I go into this, let me say a couple of other things about general long-term liability. If you were, and this is the best way to think about it, you decided to purchase a home, and you had a choice between community A, B, or C. What kind of things would you look for? Well, you want a nice, safe community, right?
Yeah.
You want a community with good school systems. Mm-hmm. And since now you have taken this class, you're maybe going to take a look at the financial statements of that community. And one of the reasons why you want to take a look at the financial statements of that community is because you want to look at the amount of debt that it carries. Because who is ultimately responsible for paying that debt?
Taxpayer.
The taxpayer. So for that reason, people said it's not a good idea to give government a blank check to go out and issue bonds. Every time they issue bonds, what happens? Well, my property taxes might just go up. Now, there's not a direct relationship, but this is the way people think. So what happened was that in the state statutes, for instance in New Jersey, it says that no community can raise more than a specified amount of debt. And that, the term is called debt limit. You can only issue an amount equal to X amount. And by the way, how is that X amount calculated? The way it's calculated very simply is by taking all the taxable property in your community. So let's assume it was $100 million for your entire community. And the state of New Jersey says that you cannot have more than 3.5% of debt as tax-supported debt. So how much can they issue? $3.5 million max. That's all that they can have outstanding. Okay, this is for a community with what? With 100 million, right? Now the issue is, the question is that if you were a bond analyst at Moody's, and this community decided to issue some bonds, they were still within the limit. And your boss asked you, could you do some financial analysis on this bond? And you look at it and say, yeah, they're still within the 3.5%, not a problem. Well, what do we know about the governance structure in New Jersey? You have what? Towns, and then what do you have? County, and then the state. So when you get your property tax bill, your tax bill, think of it as a pie with 3 slices. The first slice is for paying for government service, local government, right? Things like police, fire, all the stuff that goes in. Second is for what? Schools, to pay for the schools in your area. And the third is for county government. Okay. 3 slices. Now, in New Jersey, not only are municipalities, can they go out and issue bonds, counties can do the same. Think about it. So you say, all right, what does it mean? So these guys go and issue this much, and then the county goes and issues this much. And where is the county going to get its money to repay the debt? The same property tax. That's the concept of overlapping debt, which we'll talk about. I'm just introducing you to these concepts, okay? So first was debt limit, overlapping debt when you have more than one entity which places a tax burden on it, right? Third item. So remember I gave you the example, $100 million of taxable value, not exempt property, taxable value. And you have $3.5 million, which is there, that you can issue. So you've issued $1 million so far. How much more can you issue? So if it's $1 million subtracted from $3.5 million, what do I have? $2 million. That $2 million, the word is debt margin. That's what's left, right? So we just learned the little technical jargon that's used. Debt limit, debt margin, overlapping debt, and direct debt. And we'll talk about that, okay? Now, coming back to this slide, and I digress from this because I want to give you first an overall view before we go into each of these. Remember I said to you general long-term liabilities are principally bonds that are issued. Well, the book there's one area which the book points out where a entity would have to recognize a liability. Let me give you an example. 2 miles this way in the town of Kearney, if you drive along Route 280, before you get to the turnpike, the last exit says Kearney. You come off it, there's a little Walmart. Just before Walmart, there is a very obscure sign. It says Standard Chlorine. I said, what is this? Like a, closed up boarded place. Well, that's a Superfund site. Now, do you know what a Superfund site is? Okay, Superfund site, in short, is an environmental disaster. Okay? Basically, what it says is that the federal government has designated that area so hazardous that it's on their list of cleanup around the country, like on their top list. And New Jersey has a lot of these Superfund sites. So besides the federal Superfund sites, we also have state Superfund sites. And then some going further down, some communities also have their own areas that need to be cleaned. Next thing, when you go out to buy a home, the one thing you check is what? Go to the EPA site or DEP site and see if there are any contaminated properties around where you are. Your broker is not going to tell you that. It's going to tell you if it's on the property, but not if it's anywhere close to it. Okay? So, but anyway, not to digress from this. So, getting back to this, basically what Gov't has said is that a government must recognize a long-term liability on its books if it is responsible for cleaning up one of these contaminated sites. And you will see in the book, there are several conditions that have to be met. There are 4 conditions that have to be met. One is that the site has to be awful in terms of an imminent danger. The site has to close. Another one is that the government has to acknowledge its responsibility as a responsible party that is responsible for it. And third is interesting because it says that government could have violating a permit. And by that violation of the permit is now responsible for that violation. So there are 3 or 4 conditions which you should read about in the book, but once those conditions are met, you are supposed to estimate the cost of cleanup of the site and disclose that in your financial statement. Okay, so that's why this kind of thing sticks out, because it's kind of unusual. But as you can see, they talk about how the liability is to be measured, but that's on this pollution remediation. Okay, so just a couple of basics. One, general long-term liabilities are reported in the governmental activities column of the government-wide statement. We know that, right? Not in the liabilities of the governmental fund. We know that, right?
Yeah.
And a debt service fund should be established to account for the principal and interest payment on general long-term liabilities. So the question is, when do you establish a debt service fund? Do you establish it every time you go out and borrow money? And actually, there is no clear-cut answer for this. Yeah? No, probably not. Short-term, yeah, because general long-term liability, yeah. Usually, 2 things trigger it. One is if it's required by the bond indenture or the bond resolution, which says you must establish a debt service fund. A little like you go out and rent an apartment, and the landlord says, you know what, I want a month's rent in advance. The bondholders might say, I want 6 months of interest in a debt service fund. Same analogy, okay? So debt service fund, that's the first reason. The second reason is when it makes, and this is kind of a tough term, how to define, when in your opinion it makes good sense from a financial perspective, where you want to, from what you have learned and good financial management practices there, it makes, it makes sense to do that. Okay. Let's see what's on page 2. This is an example of a disclosure. And as far as the disclosure goes, notice how things are laid out. Notice that the enterprise fund, which is what proprietary fund, is kept separate, supported by this BJP revenue, which is a special source, which is kept separate, and then everything through general revenues. Notice how it's divided, and then they even have a component unit. This is a standard disclosure where we keep things separate. Things that should be paid from the general fund resources, from things that are paid from other sources. And notice that we saw principal and interest divided. So you see what it is for all these years. Now, we did talk about the debt burden. Now, what I want you to do is, let's take a look at illustration 6.5 and on page page 218. Yeah. 218. A couple of things that notice how they show as a schedule direct and overlapping governmental activities then. The general obligation and the estimated share of overlapping debt. Now you might say, how do we come up with this estimated share? Well, let's take a very simple example. A county has 3 municipalities, and each town occupies 1/3. The county has debt of $100 million. How much would be attributable to each of the towns? 33 million, right? That's that portion right there. That's how that's calculated. Based on what? Based on the ratables that are within the county. So each one, so if Newark, for instance, comprised 10% or 15% of Essex County, you would get what? 15% of Essex County's debt show up as overlapping debt here. Now, why do we do this? And this is what I was saying to you earlier. If you're an analyst with Moody's, you want to know, get what? The total picture, right? And that total picture includes not only town, but it includes everybody else who can come to you for property taxes. Okay. And that's how that is. So you see the direct debt and the overlapping debt, and it gives you the total overlapping debt. Yeah.
So when claims get reassessed,
yeah,
and the property values go up, that affects the initial debt that
No, actually it doesn't, because what happens is when, and I don't want to go too much into this, but it's a great question. And let me give it to you this way. There is the assessed value of the property, and then there's the market value. They're never the same, usually. So our question is, if the assessed value in one town, let's say in the first town the assessed value is 80% of the market value, but in the second town it's only 60%. How can you compare that? Because they're not comparable. What we do is there's another term which I'll give you that term. It's called equalized valuation. Where what we do is we take that number. So if it's 80%, we take the assessed value and divide that by 0.8 to equalize it to 100%. Take the other value, divide that by 0.6 to come up with the equalized value, so we can compare apples with apples and not apples with oranges. Yeah. Let's take a look at another illustration, which is illustration 6.3 on page 216. Now, what I want you to do is just take a minute to go through this and see if you understand this. So we have all these years, past 10 years, okay? Notice some of the, so you have the debt limit, which is calculated, right? What I want you to notice is this. Debt limit is what? 5% of estimated valuation. What was the valuation? 3.6 billion, and it gives us what? 182 million, right? That's what? Our debt limit, right? Everybody got that, right?
Yeah.
Okay. This is the amount which is applicable to the limit. The debt which has been issued, which is what? 98 million. See that matches with this, right? Okay. How much more can you issue? You can issue what? Another
None.
$83 million, right? And then they have a little measure total net. So you have issued what? 53, 54%. Now what I want you to do is just take a look at this and we'll discuss it a little bit. They actually have 201 million outstanding. But some of this debt deals with the, for instance, a proprietary fund or a fund that's responsible for paying its own way and therefore should be excluded. This is an amount which is set aside in a debt service fund or is available for general obligation debt, as it says, which reduces the number. So you're looking at the net debt number, okay? But I want you to just get the concept of how this calculation is done. So what did we do first? We took the total estimated valuation multiplied by whatever the percentage was. That gave us the debt limit. From the debt limit, we subtracted what? Outstanding debt. And that gave us what? The debt margin. And that's it. The any questions? Yeah. Well, it's a good question because if it's yes, because they don't have any choice. Someday I'll tell you in New Jersey, it's almost impossible to default, but in other parts of the country it's happening, as you know.
The rating of one kind of debt is part of
Yes, it could be a factor. Absolutely. General broad, you know, what's around you, how that might impact you from the overlapping debt that you see. Yep, good observation. Yep. All right, so we talked about the overlapping debt. Yep.
I'm sorry, I just missed in the illustration 623,
Yep.
which number is the debt margin?
The debt margin is the very last number. That's the amount that can still be issued.
Okay.
There you go. Yep. Okay, so we talked about, so does everybody understand what debt limit is and debt margin is? Now let's see if we know this. Let's go to question 6.5 on page 211. I'm sorry, what page is that? No, the page number is wrong.
41.
241?
Yeah.
Thanks. Okay, here's the question. You're asked to calculate the city's debt limit and debt margin. Think about it. What was debt limit? Think about that. What's debt margin? See if you can calculate it. Okay, who wants to volunteer the first one? Debt limit. What's the debt limit of this place? 1%. City. Yep. Right, everybody got that? 108,835,110, right? Exactly what? the next question is, what is the debt margin? So let's take a look at it. And this is approved but unissued tax-supported debt. Which one would you take, and which one would you not take? Is unissued tax-supported debt real debt outstanding? No. Revenue bonds issued? No, because, and I haven't, revenue bond are bonds issued by a enterprise fund because they're backed by the revenues of that entity, right?
Yeah.
So therefore, they are not counted in this calculation. Yep.
So the whole idea of encumbrances doesn't apply here.
No. Yeah. Encumbrances, we're done with, at least for now. Okay. General obligation serial bond. Does that count?
Yes.
Yes. How about capital leases outstanding? This one I haven't given you the answer. So unless you read the chapter, you wouldn't know.
Yes. Other financial sources.
Actually, you know what? It does not count. Capital lease obligation is not included in the calculation of the debt margin. And that's the reason why a lot of the towns, what happens is, if they have a choice between going out and issuing bonds or doing a capital lease, they'll pick what? The capital lease, because that doesn't count in the calculations for the debt margin. I know it sounds strange, but that's what generally the rule is. Yeah.
But actually, no, that's important. If they want to show debt, if they just decide to increase the ratio of property value assessment,
No.
or if they just decide
No,
that-
because it's based on the equalized valuation. So they can raise it, but what happens? So you raise it from 80% to 90%. If you divided that number by that, it will give you exactly the same number. If something's at 100% and you are, it's now at 90%, in order to raise it from 90 to 100%, you divide that by 0.9. It's the same thing as taking the 80% number and dividing it by 0.8. So the both numbers are exactly the same. It does not matter. The only way to add to it is by building more in the town.
I said this
Yeah.
first headline,
Yeah.
not changing the rate, but changing the actual value of property in the town
Yes.
by building.
By building or improving. Yep, exactly. So does everybody get this? So what did we get? Two lessons out of this. One is 3. Unissued tax-supported debt is not included in the calculation. Revenue bonds are not included, and capital leases are not included in the calculation.
So the answer, so
Yeah.
the answer would be the debt limit.
Oh yeah, I didn't give you the answer. What was the answer after you deducted? What was what? 108 million, right? 108 million minus 43 million, right?
It's 65.
It's 65,635,110.
Yeah.
108,635,110, which is the debt limit, less the amount outstanding, which is 43 million, gives you 65,635,110. So everybody clear about these concepts? Now comes some of the other measures that are used. Debt burden measure, debt per capita. What does that mean? Per capita. Per capita means per person, right? Yes. So debt divided by the number of people, right? And this is the one that we use at the federal government level quite a bit, right? Because when we look at those numbers, it's pretty scary, right? Okay. Ratio of debt to estimated true value of taxable property. Ratio of debt service expenditures to total general expenditure. The whole whole point here is that what you want to make sure is if you have a budget of $1,000, you don't want to be paying $500 of that in debt service costs. And what's happening to our federal government budget? As our debt, the only thing that's saved us all this time is the low interest rates. But as our debt goes up, what happens to our discretionary spending? It goes down. So that's why if you took out interest on debt, you took out defense, and you took out some of the social programs, there isn't much room for anything else. So you can fight about where money could be spent, but really that's where most of the money is going. And so these are some of the, and we'll look at this more in chapter, I believe, 11 or 10, which talks about analysis of government financial statements. So let's take a look at debt service funds. So when we talk about debt service funds, remember I said to you, what do? They service debt by making principal and interest payments, right? Where do they get the money to pay those, make those payments? From taxes. Who collects those taxes? The general fund, right? That's one source. Another source is through special assessment. And another source is if a tax is levied for a specific improvement, such as building a facility or something, and that is separated out from the rest of the tax bill and everybody pays for it. So there are three sources from where money can come into the debt service. But most of the time, it's from the general fund. It says the number of debt service funds should be held to a minimum. GASB recommends a single debt service fund for all tax-supported debt service by property tax. Well, you can have one, but if each bond indenture requires its own debt service fund, you'll have to have a separate one. And interestingly enough, if you go into government and talk to accountants there, for some reason, they like to set up debt service funds for each of the bond issues. Makes it easy accounting-wise, but you can combine it. So what we're going to do next is talk about the two principal types of bonds that are issued by government. Okay? And half of the chapter is about this topic. So what I want you to do is just pay close attention to, we'll try to keep this as simple as possible. The first type of debt is known as a serial bond. First type of debt. And as you can see with the serial bond, it matures every year and you have to do what? Pay principal and interest. Straightforward. No sweat. So what happens? General fund sends the money to the debt service fund. What does the debt service fund do? Pay the bondholders, right?
Yeah.
And that's done. It happens each year. It keeps on coming and just goes out. So that's the easy one. The next type of bond is a term bond. Now things get a little bit more complicated with a term bond. Term bond is where you have to make a final principal payment at the end of the term. So basically, during that period, you are making only interest payments. So you might say, what's so complicated about that? I have a bond, I make interest payments and at the end, pay off the principal. What's so complicated about it? Well, so let's think about it. The 10-year term bond. $1 million comes due at the end of the 10th year. You pay interest at 5% each year, make those payments, What happens at the end of the 10 years? Ready to pay up that $1 million?
Yeah.
Where do you find the resources for that? $1 million all at once? So if you were a prudent financial manager, what would you like to do each year? Borrow again. Great. Great. You'll fit right into government. Right? Borrow again. We'll talk about that when we talk about refunding. Okay? But what we like to do is, and don't make it any more complicated, what we'd like to do is set money aside each year for the repayment of that. Now you might say, no sweat. $1 million divided by 10, what do you get? 100,000, that's the amount that we. But then we put our finance hat on. What's going to happen when we take 100,000 and put it into an investment? We're going to do what? Earn interest, right?
Yeah.
And we'll do that each year, right? Each year we'll put 100,000. So what will we have? We'll have a lot more than that $1 million. Well, that's where are those little fancy calculations come in. And remember I told you, before you graduate out of this place, you have to know how present value and future value calculations are used. Remember I told you there are 4 things you should never forget. How present value is calculated and how it's used. How future value is calculated and how it's used. How present value of an annuity, which is what? Recurring number, and future value of an annuity. So you got to pick one of those 4. So let's think about it. Present value. What's present value? Present value is calculation of a sum in today's dollar that you're going to receive in the future. So if you're going to get $1,000 a year from now, the present value is going to be what? Less than $1,000, right? What's future value? Future value is when you deposit $1,000 today, what is it going to be? It's going to be more a year from now, right? Now things get a little bit more interesting. So you have just won the lottery. Lily, you just won the lottery. Okay? The state comes in and tells you that you won this lottery and you have a choice. You can take $1 million every year for the next 20 years. Okay? Or you can take a lump sum today. Right? Say, you know what? I think I know how to do this. What I'm going to do is calculate the present value of an annuity. What is the present value of receiving $1 million for 20 years? What would that equal in today's dollars? Okay? And you'll make that decision, right? So if you see that the present value of uses a rate which is just not reasonable, you would not accept it. But if it's, if it's in your favor, and that's how people do it. Obviously, I'm keeping it simple because there are also tax implications. But that's where the present value is from. Now let's go to the future value. So Lilia, again, you want to save for your retirement. You're going now the other way. And you said, I'm going to put $6,000 into my IRA. Whatever number. Okay, and I'm going to invest it, and I think I can make 6% each year. And by the time I retire, I like to be a millionaire. Okay. Well, at that point, you start to deal with the future value of an annuity because you're looking at the future value of your series of payments. Now, why did I go through all of this? Because the term bond uses one of these, and we'll go through how it uses that. So as I said to you, term bonds are a little bit more complicated because you have to do this calculation and you have to deposit that amount each year. So let's do the first one, which is serial bond, and then we'll get to the term bond. Okay, so actually, this is what we just talked about. Notice one of the disadvantages. Usually requires a sinking fund and therefore an investment management. Therefore, accounting is more complex than for serial bonds. Well, if you're putting money aside and it's earning a certain amount each year, what if it doesn't earn that much money? Are you going to have the $1 million at the end of the 10 years?
No.
There's a risk. This is not a guaranteed gain, right? So that's the risk that you have, and therefore investment management is more important. Uses modified accrual with one exception, and this is something interesting. One good thing, Liz, is there's no encumbrance accounting, so you don't have to deal with that. Okay. Uses modified accrual basis, but modified accrual basis is interesting here. Let me give you an example. And this is one of the more important things to remember in this chapter. You issued a bond on March 1. The bond pays semi-annual interest, March 1 and September 1. First year, you make an interest payment on September 1. How much interest do you recognize on your book? First year. This is what I want you to think about. Modified accrual basis. Let me give you an extreme example. You issue the bond on January 1. Interest is due on July 1 and January 1. First year, you don't make an interest obviously on January 1 because you just issued the bond. First year interest is paid on what? July 1. When's the next interest due?
January.
That's next year. What happens? Do you recognize the 12 months of interest in the year? No, even though it's only what? 1 day. Because of the basis of accounting that we are using, which is what? Flow of financial resources. And the term here is you recognize interest expense. I'm sorry, you recognize interest and principal when it's legally due. Not before, not after. Literally on a cash basis. Now there is an exception to that you'll see in the book where if it's within 30 days, you may recognize it before. But generally the rule is when it's due. There's one other thing about term bonds, and we'll take a look at each of these examples. Term bonds, obviously the sinking fund is invested. Do you guys learn fair value accounting?
Yeah.
Okay. Well, what happens with investments at the end of the year? How do you report them? Mark to market, or you have to show change in fair value as either unrealized gains or losses. Okay? And I won't go too much into this, but fair value basically requires you to mark your investments to market value. So the sinking fund investments have to be marked to market. Yeah. The what? Write down, well, if there's an unrealized loss, you'd have to show that as part of your. No, these are, I'm talking about investments. No. Yeah. By the way, how many of you used the Bloomberg machine outside? Okay. I'll tell you what. That's a great resource. You want to see what's going on? If I were you, you know how much that machine cost? I used it in my previous position. thing costs like $2,500 a month to rent. And I used it for bond trading, but even though $30,000 is a lot of money, but when you did one trade, and if it made the difference, if you did multi-million-dollar trades, you needed to know, pricing, very accurate pricing. But if you can, try to see if you can get on that machine. That is a wonderful resource. In fact, if you decided to ever become a trader, you would have to pass the exam to learn to use that machine. And that's what made Mr. Bloomberg, or Mayor Bloomberg, a billionaire, is that machine out there. It's one of the greatest things. You can monitor the Chinese stock market right from here. Any stock exchange, anywhere in the world, bond pricing,
Do we need a Rutgers ID?
Well, you actually have to set up an ID. Yes, it will ask you for the net ID, and then you can set it up. So it has bond pricing, equities, currency, commodities, municipal, all news, rich database of, how many times you've given an exercise, do this analysis of the company. You have to do anything. Just go in there. Hit a button, and you've got everything that you'd ever wanted and more. You want to impress somebody, and especially if your professor doesn't know, then he'd say you are like, said, geez, how did this person ever get this information? So there are, if you can, it's really well worth it. It's right outside, I think, on the 5th floor, on the corner there. And for those of you who are really into hardcore financial stuff, one of the most active screens to watch is the options trading, where there's a lot of action. All right, so what I want to do next is, let's talk about some of the journal entries. Let's talk about the journal entries for the serial bonds. So one of the things you'll notice is that even though budgetary accounting is not necessary in debt service funds, a lot of people do carry out budgetary. And the way they do this to record the budget is to estimate other financing sources, you get it, and what would the credit be? So based on you, the money is going to use. Notice one thing. You use the revenue. What is it called? Other financing sources. Where is this money coming from? From the general fund, right? That's where it's coming from, right? What's the next step that happens after you do this? You do what? You get the cash, right? What I'm doing, trying to do is, there are multiple sides of this. I'm trying to translate everything on the board. So we receive cash. What happens when you receive cash? You debit cash. And where are you getting the cash from? General fund, right? So it would be other financing sources, general fund, interfund transfers, in whatever you want to call it. Okay. That's the first thing that happens, right? Second thing. Next is you're ready to make the payment. Payment to bondholders. What do you pay them? Principal and interest. So there is one, what is it called? Expenditure, principal, and expenditure, interest, and everybody got that? Two debits, one to expenditure principal and one to expenditure interest, and cash is credit. So far, so with the governmental activities ledger when we budget?
No.
No, there's no entry. First one is none. Nothing's happening at the governmental activities level. How about the second one?
Cash.
These cash, shouldn't we record that in the governmental activities?
No.
No, I want you to think about this. Where's the cash going from?
General fund.
Fund to the debt service fund. What is that? Do we do that with governmental activities?
No.
None. All right. Number 3, payment to the bondholder. Well, that's going outside, right? That we should record. So the question is, how do we record that? Well, first of all, let's do the easy one first. Instead of calling interest expenditure, we call it just interest expense. And based on the accrual basis of accounting, what do we do?
Bonds payable.
Bonds payable or notes payable, whatever you have, you're retiring those, and then cash. Everybody see that? See the distinction between the two? Yep.
This entry is for the serial bond, right?
The what?
This entry is for the serial bond, right? Not for term bond.
Yeah, these are serial bonds. Yeah, these are serial bonds. Yeah. Okay, so everybody with me here, right? Okay. Did you get this down? Can I take it off? See, what I'm trying to do is avoid all these slides that we have here by keeping it. Okay, number 4. Now the next thing is end of the year is coming. This is end of year. What happens at end of year?
Close entry.
Do we accrue interest?
No.
No accrual of interest. It's the debt service, right? Do we do any accrual in the governmental activity at the end of the year?
Yes.
Yes. And then somebody said, time to close up. Do the closing entry, right?
Yeah.
So what's the closing entry? Well, at this time, we should know what the closing entry is, right?
Yeah.
So the closing entry is what we do. We usually reverse the budgetary entries, right?
Yeah.
So debit appropriation and
Active.
credit, what? Estimated
Other financial
other
sources.
financing sources. These are the budgetary accounts, right?
Yeah.
Let's deal with the real accounts now. What are our real accounts? We have to close.
Other financing.
Other financing source, right? And then there is the expenditure, principal, and expenditure.
You should credit expenditure.
No, this is closing entry. We have to close it out. Remember we debited before?
Yes.
So now we have to close it. We have to close it at the end of the year.
You should credit from the other side.
No, because the first was debited. Now we have to credit it.
Yes.
Do you see it?
Yeah.
When we were, okay. Do you
Yeah.
understand?
Yes, I think we credit expenditure, right?
Yeah, this is credit. Debit and credit.
Oh.
Debit and credit. I'm sorry. Debit, this is debit and this is credit. Yeah. Do you see this? This is the standard cycle. There's no variation. This is it. Okay. And we talk about this. There's this example which goes on, so I'm going to go through this. Okay, now we come to the term bond. Okay? What I'd like you to do is, using this, just follow through in the slides. But I wanted to show you what the journal entries are. Now comes a little bit, slightly more of a challenge. Did you want to take a quick 2-minute break, or? Okay, trying to do that.